Now friends, after completing the very first two chapters, that is basic concepts and residential status scope of income, now let us continue with the third chapter, income from house property. Basically this is the second head of income, but let us understand first income from house property. Section 22 till section 27 it ranges. Now first of all, when a particular income will come under this head, the question arises, sir, only residential house property we are talking about, or even commercial property is also there? So now let us understand when a particular income will be taxable under this head, section 22 basis of charge. The first condition, the property which you have given on a rental basis, it should consist of building or land appurtenant thereto. When I say building, it may be a commercial complex, it may be a residential building. When I say land appurtenant, it is the land which is attached to that building, not a vacant land. It is attached to the building, like a garden which is attached to my house, a parking area which is attached to my bungalow, like that. So if it is a property consists of building or land appurtenant thereto, condition number 1 satisfied. Condition number 2, you should be the owner of the property. Owner. Even though registration is pending, if agreement is done, you are the owner of that property. And number 3, and this is the most important condition, property should not be occupied for the purpose of your own business and profession. You are not using for your own business and profession. So let's say I have an office in my ownership, I am using it for my own profession, I am doing my practice from that. It is not called as house property, it is my business asset. But if I have an office in my ownership, I am not using it, I am giving it on a rent, then it will be called as a house property because I am not using for my business or profession. Now the question arises, sir, if a builder or constructor is giving a property on a rent, then what? See, you have to see what is the main business of their constructor. If the main business consists of only selling the house property, not giving it on a rent, then rental income taxable under the head house property. But if the main business includes the business of giving the property on a rental basis, then that rent will be taxable in PGBP, not under house property. Now, there may be 3 types of house property. Once you decide that this is my house property, okay, now decide it which kind of house property it is. See, if you have a house property, what you can do? Number 1, you or your family member can stay in that who are not paying you the rent. Either you or your family member. So that property will be called as self-occupied property. We will be calling it as SOP, self-occupied property. Other what you can do, the use of that, you can give it on a rental basis to somebody else. That is, you are giving it on a rent, you are letting out, and that's why the property is called as let out property, LOP, let out property. Third, what you can do, you are neither using it for your residential purpose, nor your family members are using, nor you have given it on a rent. The property is fully vacated. It is just vacated for the entire year. Government say we can't believe that a property can be, full time vacated. And that's why a property which is not SOP, which is not LOP, that will be called as deemed LOP. Government will assume that you have given it on rent. One more kind of property is there which will be called as deemed LOP. For example, I have SOP in my ownership. I have 3 SOP. One in which I am staying, second one my parents staying, third one my brother staying. Government said you can't have more than 2 self-occupied property. If you have, we will assume that up to 2 property it will be self-occupied. The third property or third, fourth, whatever properties you have, that will be deemed as LOP. It can't be SOP. So maximum how much property you can have as self-occupied property? Maximum 2. Balance will be called as what? Deemed LOP. Acha, even if I have only 1 property, but let's say if it is not SOP, not LOP, then also it will be called as what? Deemed LOP. So there are the 2 cases where deemed LOP concept is used. Now once you decide that which kind of property it is, then what you will do? You will calculate your income from house property. There is a fixed structure that you have to follow. First, gross annual value. In short, we will be calling it as GAV, gross annual value. Now sir, what is gross annual value? I am teaching it later on. First of all, gross annual value minus municipal tax, that is property tax, water tax, etc. paid by the owner during the previous year. If during the previous year owner has paid the municipal tax, deduct it from gross annual value. The balance you will get is what? Net annual value, NAV. From net annual value, we will be deducting two deductions. Section 24 clause A, section 24 clause B. Now what is 24 clause A? See what government said, for a house property you may be claiming electricity expense, maintenance expense, security guard expense, watchman expense, sweeper expense. There are so many expenditures that you can claim and you can make your income from house property zero. We don't want it. And that's why we will be giving you a standard deduction 30% of NAV. So from NAV, the first deduction will be section 24 clause A, 30% of net annual value. Second deduction, 24 clause B, interest on borrowed capital. To purchase the house, to repair the house, if you have taken the loan, then whatever interest you are paying on that loan, that will be called as what? Interest on borrowed capital. That you can also deduct from here. And the balance you will get is what? Income from house property. So what is the fixed structure? GAV minus municipal tax, so balance net annual value, minus 24 clause A, 30% deduction, minus 24 clause B, interest on borrowed capital. Now let us understand one by one each of the following steps. See, first I will teach you all the general provisions and then we will be going on a special provision. First, general. Now, how to determine gross annual value? Now first we are discussing about let out property, right? See, they said I can't rely you for your actual rent. And that's why they want us to compare their expected rent with our actual rent, and whichever is higher will become our GAV. So expected rent or actual rent, whichever is higher. Question arises, sir, how to determine expected rent? There are three steps. Step number 1, municipal value or fair rent, whichever is higher. Municipal value, the rent which is decided by a state government for collecting municipal tax. Fair rent, which is a market rent, which is ongoing in your surrounding, whichever is higher. Step 2 says whatever answer you have determined from step number 1 or standard rent. What is standard rent? It is the maximum rent that legally a owner can collect from the tenant as per Rent Control Act. So step 1 or standard rent, whichever is lower, because you can't collect rent more than standard rent. That's why whichever is lower. So the balance which will be coming is called as expected rent. And step 3 says compare that ER, that is expected rent, with AR, that is actual rent. Whichever is higher will be GAV. So finally, what is gross annual value? Municipal value or fair rent, whichever is higher. That amount of standard rent, whichever is lower, which will be called as expected rent. Last, expected rent or actual rent, whichever is higher. But understand, over here actual rent you have to take not on receipt basis, you have to take on due basis, on accrual basis. Whatever is accrued that you will take, not whatever is received. Now it may be possible that let's say I have given a property on a rent for 12 months, let's say. And the rent of 12 months is also accrued. So I have to include in actual rent full 12-month rent. However, my tenant has not given me the rent for let's say 2 months and it is now bad debt. I can't collect it. He is not giving me. So can I say my actual rent should be reduced by the rent of this 2 months? Yes or no? Yes. This bad debt which you can't collect from the tenant as of now is called as unrealized rent. What it is called as? Unrealized rent. When any rent which is not realized can be called as unrealized rent if condition of rule 4 are satisfied. Number 1, tenant has vacated the premise or steps have been taken to make him vacate. Obviously, if he is not paying the rent, you will throw him out the property. Second condition, you should start collecting the rent. You should take some legal proceedings to prove that it was a genuine case. And third, if you have given him 2 properties on a rent, he is not paying you the rent of 1 property, but obviously you will throw him from both the properties, na? Because you have a fear that what if he is not paying the rent in future. And that's why third condition says tenant is not in occupancy of any other property of the same owner. If all the 3 conditions are satisfied, then that not realized rent will be called as unrealized rent. Now what to do if you have unrealized rent in the question? First of all, government's expectation will never be reduced. Expected rent will always be of 12 months. But here while calculating the actual rent, we will be not taking 12-month rent. Here we will be taking 12 minus 2, that is only 10-month rent. And what we will be doing is later on, whichever is higher is what? Your gross annual value. So understand, here expected rent will not change, it will be always of 12 months. but actual rent will be reduced by that month for which unrealized rent has happened. Whichever is higher is your GAV. This is alternative number 1. Alternative number 2, here you take actual rent also for 12 months. Expected rent also for 12 months, actual rent also for 12 months. Do whichever is higher. That is your GAV. And from the GAV, ultimately you deduct unrealized rent. Now it may be possible that under both the situation answer may differ. And the second situation, second option, to reduce unrealized rent from GAV more seems logical. But still in exam what you will follow? Expected rent 12 month, actual rent 10 month, whichever is higher is your GAV. Means reduce unrealized rent not from GAV, from actual rent. Sir, what if we follow the second option? It is not wrong, it is also true. But what ICAI is doing, generally they follow the first view and they write the second view as an alternative. So what we will be doing? The same procedure. Now what if, see, the first case was where the property you have given on a rent, tenant is not paying you the rent, so it is unrealized rent. What if you have given a property on a rent up to December, then tenant vacated the property, and January, February, March, this 3 months, no tenant is there in the property, even you are not using it for SOP also. Can I say that 3-month property became vacant? Now this will be called as vacancy loss. That 3-month rent which you could not realize because the property was not given on rent, that is called as vacancy loss. Now sir, whether it is called as deemed LOP because it is not LOP, not SOP. Deemed LOP concept comes into the picture only when for the full year it was vacated. Here only for 3 months it is vacated. So loss due to vacancy concept will be there. Now let's say my expected rent for the full 12 month comes to 1 lakh. My actual rent for 10 month. Why 10 month? 2 month property was vacated. So 10 month rent will come to 1,10,000. Simple. What is my GAV? Whichever is higher, that means 1,10,000. Now here what government says, if your actual rent even after deducting the vacancy loss is more than expected rent of 12 month, you simply have to do whichever is higher and actual rent will become your gross annual value. But let's say over here for 10 month my actual rent comes to 90,000. Comes to 90,000. So can I say my actual rent is lower than expected rent? But what argument I'm doing with the government? That expected rent is of 12 month and I'm comparing my 10 month of actual rent with that. Obviously your answer will be higher. How you can tax me on that 12 month rent? Government said, okay, let us check. If you would have received full 12 month rent, what would have been your total rent? Can I say here if I would have received full 12 month rent, then my total 12 month rent would have been 90,000 divided by 10 multiplied by 12, that would have been 1,08,000. At that time, it was higher than my expected rent. But today it is lower than my expected rent. Can I say it is lower than expected rent just because of vacancy? I am genuinely affected due to the vacancy loss. So here government won't harass you much. Government will say whatever is your actual rent of 10 months, take it as your gross annual value. Means if your actual rent is less than expected rent, then you see what is my actual rent if there would not be any vacancy. If that amount was more than expected rent, now it is less than expected rent, then actual rent will become your gross annual value. But let's say here 10 month actual rent would have been 80,000 only. Still it is lower than expected rent. So now check. Now you check what would be your actual rent if there would have been no vacancy. If there would have been no vacancy, then my actual rent would have been 80,000 divided by 10 multiplied by 12. That would be 96,000. Can I say it is still lower than expected rent? Now also it is lower than expected rent. You are not affected due to vacancy. Your expected rent is always higher. So government won't give you any kind of special concession. Your GAV will be equal to the expected rent. Simple. So here you have to assume that what would have been the rent if there would have been no vacancy, to check what at that time, what at now. The both example I have given over here also. Now whatever we have learned up to now, that was gross annual value for let out property because actual rent was connected somewhere. If it is a self-occupied property, remember the gross annual value of a self-occupied property will always be 0. The reason you are staying in that property, why we will calculate the rent. And that's why GAV of self-occupied property always 0. But if it is deemed LOP, then remember, expected rent will be the GAV for you because there is no actual rent. And in 3 steps, if one of the figure is also not given, you can't assume it as a 0 figure. You have to just ignore that step. Here, actual rent is not available because it is deemed LOP. So simply expected rent, that is after step 1 and step 2, whatever figure is there, that will become your gross annual value. Now that was the very first step, gross annual value. From the gross annual value, what we deduct? Municipal tax paid by the owner during the previous year. Now when I say municipal tax, it may be property tax, it may be sewage tax, it may be water tax, whatever tax government is collecting from you with regards to your house property. Now if it is given as a percentage, let's say 10%, 12%, that percentage is always of a municipal value. It is not of GAV, it is not of actual rent, it is not of expected rent. Percentage of municipal tax is always to be applied on municipal value. Now you can deduct that municipal tax while computing your income from house property only if you have actually paid during the year, being a owner. So let's say you haven't paid that, your tenant has paid that, you can't take deduction. Let's say municipal tax of this year is 5,000. You paid only 3,000, rest 2,000 you are paying in the next year. This year only 3,000 you will get as a deduction, for balance 2,000 no deduction because you haven't paid it. Then for example, this year I am paying total 12,000 rupees of municipal tax, 10,000 of this year, 2,000 of last year. How much deduction I will get in this year? Full 12,000, because whatever you pay you get the deduction. Then don't see of which year it belongs to. Let's say I am a R&OR. So can I say for me global income is taxable in India? I have a property in Britain. Now let's say Britain government is also charging municipal tax from me. Now whatever rent is coming from that property, I am a R&OR, that is taxable in India. The question arises, sir, municipal tax paid in that country, can I deduct that from the rental income which is taxable in India? Chennai High Court, that is Madras High Court, has given the judgment. Whether Act says municipal tax should be paid in India? No. Second, if you can tax the income of other country, you should give the deduction of expenditure which are incurred in the other country. And that's why if your house property is outside India, then municipal tax paid outside India is also deductible as per the judgment of Madras High Court. Name you have not to remember. If the property is a self-occupied property, GAV is 0, even municipal tax also you can't take any deduction. But if the property is deemed LOP, you are calculating the income by taking sum of the gross annual value. So same like let out property, you will get the deduction of municipal tax over here also. After deducting municipal tax, what you get? Net annual value. From net annual value, what you have to deduct? Section 24 clause A, 30% of NAV. But remember, once you are deducting this 30% of NAV, you can't deduct any other expense. Only 3 expenditure are allowed in house property. Number 1, municipal tax. Number 2, 24 clause A. Number 3, 24 clause B, interest on borrowed capital. Otherwise, no other expense is deductible. However, the standard deduction of 30% is not allowed when your NAV is 0, and mainly your NAV is 0 if your property is a self-occupied property. One other condition is also there, up to 2 years from the ending of the year in which certificate of completion is received for a builder. But that is okay, not that important, that's why I have not covered here. So 30% of NAV you can deduct. That is 24 clause A. What is the next and the last deduction that you get in income from house property? Section 24 clause B, interest on borrowed capital. Now, government wants you to take your own property. For that you may be taking housing loan, either for the purchase or for the construction or for the repair of the house or for the renovation of the house. Government said you take the loan either from bank or from NBFC or from government or LIC or friend or relative. You take a loan from any person, you pay them interest, whatever interest you will be paying per year, you will get deduction in 24 clause B from your income from house property. Now remember, principal repayment, you are not getting deduction over here. For that 80C is there. Here you are getting the deduction only for what? Interest on borrowed capital. Now you have to check which kind of house property you are talking about. It is let out property a deemed let out property? If yes, no matter what, for what purpose you have taken the loan, it may be for repair, renovation, purchase, construction of the house property. Per year, whatever interest is accrued, you can get full deduction without any limit. If I have paid the interest of 2 lakh, I will get deduction of 2 lakh. If 20 lakh, I will get deduction of 20 lakh. No limit. Remember, interest on borrowed capital taken in relation to house property. If it is LOP and deemed LOP, no limit. What if the property is a self-occupied property? Can I say in self-occupied property, gross annual value is 0, municipal tax is 0, by default my net annual value is 0. If in case of self-occupied property, net annual value is 0, generally no deduction should be granted. But here intentionally government has given the deduction in case of self-occupied property. Without any income you are getting the deduction. So it will be generating a loss always in self-occupied property, which you can set off against your other heads of income. That is a beneficial provision for the taxpayer. So if it is a self-occupied property, you see for which purpose you have taken the loan. If it is repair renovation or purchase construction. If it is repair renovation, here without limit, no. Income is 0, so deduction will be granted up to a certain limit, and the limit is maximum 30,000 per year. For example, I have a property in which I am staying. I have taken a loan to do repairs or renovation of that house, and this year the interest is coming to 60,000. What will be the deduction? 30,000. What if my interest would have been only 20,000? What would have been the deduction? 20,000. What if the same property was LOP? Then in case of 60,000, I will get 60,000. In case of 20,000, I will get full 20,000. The limit of 30,000 per year is only if it is a self-occupied property. Another thing, purchase or construction. If you have taken the loan to purchase a house, to construct a house, you will get deduction for rupees 2 lakh of interest per year, provided two conditions are satisfied. 2 lakh rupees of limit for deduction provided two conditions are satisfied. Number one, the loan is taken on or after 1st April 1999. You have taken the loan on or after 1st April 1999. And second one, in the year in which you took the loan, you see whatever is the ending of that year, what is 31st March of that year, from that within 5 years, the purchase or construction should be completed. For example, I have taken a loan on 1st October 2009, I have purchased the house on 1st May 2014. See, what is the ending of this year, 1st October 2009, 31st March 2010. What are the 5 years from this date, 31st March 2015. Can I say I have purchased the house prior to this date? Bingo, I will get the deduction per year rupees 2 lakh for the loan. But if I would have purchased the house in 1st May 2015, then it is after 5 years, I would get the deduction only of 30,000. If any of this condition not satisfied, then the limit of deduction will be 30,000 per year per owner. It won't be rupees 2 lakh. So if the loan is taken prior to 1st April 1999, 30,000. If construction not completed within 5 years, then also 30,000. If both the conditions satisfied, then the limit will be rupees 2 lakh. Here one more point. This limit of rupees 2 lakh is not per house, it is per owner. Let's say I am an owner, I have two self-occupied property. One for which I have taken the loan for repair, the interest I have paid 35,000. Another one I have taken the loan for purchase, interest I have paid 2,02,000. In case of SOP, if you pay the interest for repair, what is the maximum deduction you get? 30,000. And if you have taken the loan for purchase, what is the maximum deduction you get? 2 lakh. So combinedly what deduction I got? 2,30,000. Answer is no. For your both SOP, combinedly the interest deduction cannot exceed rupees 2 lakh. The 2 lakh rupees of limit is per owner for all the SOP together. Here the maximum deduction I will get is rupees 2 lakh. But now let's say there is one house property for which I have taken the loan and the interest is coming to rupees 4 lakh. There are two owners, me and my wife. I am taking half deduction, my wife is taking half deduction, so 2 lakh coming to me, 2 lakh going to my wife. We both can get deduction of 2 lakh, 2 lakh. The limit of 2 lakh is not per house property, it is per owner. Per owner combinedly of all SOP. Are you understanding this, people? Yes or no? Remember, the deduction of interest you will not get on receipt basis, you will get on accrual basis. Whenever it will accrue, you will get the deduction. The interest deduction will start not from the year of loan, it will start from beginning of the year in which you purchase the house. See, this point will come in the picture only when the year in which loan is taken and the year in which purchase or construction is done is in two different years. For example, I have taken the loan in the year 15-16, construction completed in the year 17-18. Even though loan repayment started in 15-16, even though I have paid the interest in the year 15-16 onwards, the deduction will be available from 1st April 17 onwards only. Means interest deduction start from beginning of the year in which property purchased or construction completed. Now let's say you didn't pay the interest to the lender and he charges some penalty from you, penal interest. That penalty interest, that penal interest will never get as a deduction. Let's say I have a loan which is ongoing. To repay the loan, I have taken another loan and now I have started paying the interest for that another loan. Even to that interest also you will get deduction of 24 clause B. What I have written? Interest on fresh loan taken to repay the original loan is always allowed as a deduction. Now while taking the loan, you must be paying some processing charges, brokerage commission. You will get no deduction for that. Another one, if you are following section 115 BAC, that is the optional tax regime, deduction of section 24 clause B, that is interest for SOP, will never be available. LOP, deemed LOP you can claim, for SOP you can't claim. Last point in this section 25, if you have taken the loan from abroad, you are paying the interest in abroad. If you haven't deducted TDS while paying the interest, even though you was liable as per TDS chapter, then you will not get a single rupee of deduction on that interest income. So if you don't pay TDS, you don't deduct TDS while paying the interest abroad, you won't get any deduction. There is no provision that what if interest is not deducted while paying the interest to a resident. No provision. So that interest will be allowed. This provision applicable only if you are paying the interest abroad without TDS. Now I just said one thing. If the loan is taken in the year 15-16 and the construction is completed in the year 17-18, your deduction will start from 1st April 2017 onwards. So the question arises, sir, what about the interest which I have paid from 1st April 2015 till 31st March 2017? That is also loan interest, that is also regarding house property. But deduction start from 1st April 17. So what about this period ka interest? This period interest is called as pre-acquisition or pre-construction interest. Pre-acquisition or pre-construction interest. It is same like accountancy. In accounts, whenever preliminary expense is there, the expense done before starting the business, what you generally do? You do not get deduction in a single year, you defer it, you amortize it, sometimes in 5 equal annual installment. Same over here. Whatever is the total interest of this pre-construction or pre-acquisition period, you determine that total interest and you get the deduction from the year 17-18 in 5 equal annual installment. See what I have written over here. Pre-construction interest is deductible in 5 equal installments starting from the previous year in which construction or acquisition is completed. So what will happen that let's say in 17-18 my construction completed. So from 17-18 till 5 years I will get the deduction for that year also. Along with that I will get deduction of 1/5 of pre-construction interest. But the total interest in this case for SOP cannot exceed 2 lakh. So let's say 17-18 of its own the interest is 1,90,000 and 1/5 of pre-construction interest comes to 30,000. So total deduction what I is eligible 2,20,000. But if it is SOP, I will get deduction only of 2 lakh. If it is LOP, then I will get full 2,20,000. Sir, what if in the third year itself my loan is totally repaid? Then in 4th year and 5th year you will not have current year interest, but still that 1/5 of pre-construction interest you can get as a deduction. That is fixed 5 years. Now that was all general provision. Now let us start some special cases, that what if half property is LOP, half property SOP, for some period LOP, for some period SOP, like that. So let us start the special cases in the house property chapter. Now the very first special case. Let's say I'm doing job in Mumbai. I have my own property in Mumbai. That is SOP. My employer said, tomorrow itself you transfer yourself in Ahmedabad. So I have to go to Ahmedabad and I will stay in a rented house or somebody else's property. I don't have any property in Ahmedabad. I didn't even get the time to find a tenant for my property. I have to left the city as soon as possible. So what will happen now? That Mumbai wali property will become now vacated for the entire year. Not SOP, not LOP. But in Ahmedabad, I am staying in a rented house, in some other's house. But what government said, if it is a deemed LOP, you have to pay the tax. Can I say it is a genuine problem to a person who can't find the tenant because he has to shift to another city because of his employment, business or profession. And that's why there is a concession to them. If you transfer to some other area because of your job, business or profession, and that's why your property in that original area is vacated, it is not given on a rent, and the city in which you are going, you don't have any other your own property, then the property in which you are, you know, it is vacated will still be called as SOP and all the provision will be applied as if it is SOP. So it is a concession. Then let's say for 3 months my property was let out and for 9 months I removed the tenant from the property and now I'm staying in that property. So let's say for 3 months it is LOP, for 9 months it is SOP. Now what to do? Because if I'm considering it as a LOP, the provision will get changed. If I'm considering it as a SOP, the provision will get changed. The very first thing that will come to your mind is, sir, proportionate calculation, na? 3 month LOP ke taur pe. Then after that 9 month will be counted as a SOP. No, it is not like that. Government said you can make us full by saying that you are staying in that property and taking the rent in cash. And that's why if part of the year property is LOP, for remaining part it is SOP, assume it is let out for the entire year. Sounds illogical, but that's what you have to assume. You assume that it was let out for the full year, it was not SOP. So while calculating the answer, the expected rent will always be of 12 months. But in my example, actual rent will be only for 3 months because let out is for 3 months. So here you are comparing a cat with a tiger and looking whosoever is stronger. Whichever is higher will be GAV. Sir, here for the 9 month loss due to vacancy concept will come. Nah, it is not vacancy. I am staying in that property. How I can say it is vacated? So vacancy loss concept will also not come into the picture. So this is the genuine hardship. But against that you will get full deduction of municipal tax because it is assumed as LOP. You will get 30% standard deduction. You will get without any limit deduction of interest on borrowed capital. This all are the benefits. So when property is let out for some period and self-occupied for remaining period during the previous year, consider if as if let out for the whole year. So expected rent for the full year. Deduct municipal tax, no limit in interest deduction also. But actual rent will be taken only for those months for which rent is actually received. Do not consider vacancy loss for the period for which it is SOP. Now instead, let's say 3 month LOP, 1 month vacated, totally vacated, and for remaining 8 month, let's say SOP. So here also I will consider as if it is LOP for the full year, expected rent of 12 month, actual rent for 3 month, but 1 month vacancy loss concept will be applicable. Only for this 8 month it won't be applicable because for 8 month it was SOP, for 1 month it was totally vacated. So vacancy loss concept will be there. Now let's say I have a bungalow in which ground floor used by me as SOP, first floor given on a rental basis for the entire year. Now here I can't apply case number 2 because the property is SOP for the entire year, even LOP for the entire year. But some of the portion is SOP, some of the portion is LOP. So if you have a house in which there are 2 units, one is SOP, another one is LOP, determine how much percentage is SOP, how much percentage is LOP, and just do proportionate calculation. Now how to do proportionate calculation? See, first of all, pick up the unit which is SOP. Can I say in that your net annual value will become 0? But you can always get the deduction of interest for SOP. Now let's say for the entire house I have paid the interest of rupees 5 lakh and 50% SOP, 50% LOP. So from this 5 lakh, how much will pertain to SOP unit? 50%, that will be 2,50,000. But in SOP, how much maximum deduction I can get? 2 lakh. So loss from SOP will be 2 lakh. Now let's say for the balance 50% LOP unit, the rental value is rupees 10 lakh. So from 10 lakh deduct municipal tax. Let us say there is no municipal tax. If it would have been, let's say 1 lakh rupees is the municipal tax of the entire house. Deduct only 50,000. Why? Because your LOP unit is only 50%. So from that, net annual value will become 9,50,000. From that you deduct 30% of 9,50,000. From that you deduct 50% of the interest. 5 lakh is the total interest. LOP is 50%. So can I say what you will deduct? 2,50,000 half without any limit. So the balance which you will get is the income of LOP. There is a loss in SOP. There is an income of LOP. Now set off both. And whatever final figure you are getting, that is income from house property. So whenever part of the property is SOP, part of the property is LOP, then do proportionate calculation. For LOP, expected rent, municipal tax and interest, all you have to take percentage wise. In SOP, only one thing you have to take percentage wise, and that is interest. One more point. If let's say my house at 3 unit, one is also used for the business, then that much percentage is a business property. Whatever is the expense of that unit, that will be considered in PGBP, not in house property. That is simple. Now let's say I have 3 houses, all are used as SOP. So what I have just said in the beginning of this video, only 2 property can be SOP, the balance will be deemed as LOP. Then how to decide which property is SOP? Government has given you the option. So what I will do? I will take option number 1. Let's say there are 3 property A, B and property C. Option number 1. Property A and B SOP, property C deemed LOP. Then I will see what is my income from house property total. Then I will assume property B and C SOP, property A deemed LOP. Then what is the total income from house property? Then the third option, property A and C SOP, property B deemed LOP. Then according to data, what is the income from house property? See in which option you are getting the lowest income or the maximum loss. That is most beneficial for you for income tax. That option you will select, and that property will be called as deemed LOP. While calculating this, if 2 SOP you are considering, remember the total interest deduction of both SOP cannot exceed 2 lakh. And while calculating income of deemed LOP, what will be gross annual value? The expected rent. But there will be no limit on interest deduction. So the option which you have to select will be the most beneficial. Now, per year you can change this option. Per year. Yes. Then, what if the property is owned by more than one owner? Let's say me and Mr. Akshay. Let's say we both are co-owners. Me and Mr. Akshay both are co-owners. The property is used as a self-occupied property. Let's say we both have 50-50% share. So whatever loan we have taken on this property, whatever is the interest we are paying, I will get 50% deduction, he will get 50% deduction. I will get up to 2 lakh, he will also get up to 2 lakh, simple. For both of us, net annual value will be 0. So if co-ownership is there, percentage is decided, see the property is SOP or LOP. If it is SOP, for both net annual value 0, both can get deduction of interest up to 2 lakhs separately. But if the property is let out property, see what I will think, whatever is the GAV, divide 50-50. Whatever is the municipal tax of the entire house, divide into both 50-50. NAV, both will deduct 30%, both will deduct interest 50-50. So both will get their income from house property. Why to do this tedious task? Section 26 says very simple, calculate your income from house property as if there is only one owner. And whatever is the final income from house property, divide that into the co-owner 50-50. Why you are dividing each and every element? Divide final income from house property. But in SOP you can't do that, because in SOP both have separate limit of 2 lakh. In LOP you can do that because interest don't have any limit. So if co-ownership is there, simple, you have to do proportionate calculation. In the special cases we don't learn anything new. We just learn how to use the concept which we have used earlier. Now, after this, you will definitely see module exercise question number 5. That is very important. Now, question number 25A. Sorry, section 25A. If in earlier years I was having unrealized rent for which I am doing recovery now, or in earlier years there was some dispute regarding increase which retrospective effect I am getting now. Income is of earlier years. Recovery is being done in this year. arrears of rent or recovery of arrears, unrealized rent. Remember, in whatever year you will receive, it will be the income of that year. But from that, you compulsory deduct 30% standard deduction of 24 clause A. Even though you are not the owner of that property right now, but the income belongs to that period for which you was the owner, and that's why this recovery will always be taxable under the head house property. So if in one line I want to summarize, recovery of unrealized rent and recovery of arrears of rent, always taxable in the head house property after 30% standard deduction, always under the head income from house property. The last point of this chapter, section 27, deemed owner. I have just covered one point which is important from this. Other 4 points I haven't covered. But on the last day, you are supposed to see only this one point. Now, what is deemed owner? See, your income will be taxable under the head income from house property only when you are the owner of the property. And the word owner includes the word deemed owner as per section 27. Now, what is deemed owner? Law says, to save your tax, what you can do, you can transfer the house property without any consideration to your relative, let's say spouse or minor child. So they will get the rental income in future. They are the owner of the property in future. They don't have any other income. So whatever income they are getting is less than 5 lakh. Due to rebate, their tax will be 0 and you will save the tax. Because if you would have received, it might be possible your income is more than 10 lakh, you are paying 30% tax. So you intentionally saved your tax. So now what law said in section 27, it says that whenever you transfer a house property without taking adequate consideration, market value, up to market value you haven't taken the consideration. If you are an individual, you transferred such property either to your spouse or to your minor child who is not a minor married daughter. Then whatever rental income they will earn in future, it will be taxable to you only, being the transferor, because you will be called as deemed owner. Now you can't do this tax planning. So what the law said, if taxpayer is individual, he or she transfers a house property, the property is transferred to spouse or minor child without adequate consideration. But if you have transferred the property to the spouse not in connection with agreement to live apart, in case of divorce, then no deemed owner concept. Or you have transferred the property to minor married daughter, then section 27 will not apply. And remember, unlike Indian Contract Act, love and affection is not a valid consideration over here. So here deemed owner concept will be applicable. If you can transfer to major child, brother, sister, parents, then no deemed owner concept. It is applicable only if you transfer to spouse or minor children. Here the important topics which you can refer on the last day, which will cover 90% of house property chapter, is done. Now we will be starting income from salaries. Thank you so much.